Hello, guys. Welcome you all to the Insights into Money podcast. Let's start today's discussion, folks, on the topic, the Essentialist Investor. Why doing less makes you more money.
Yeah, thanks for having me. I'm really excited to get into this one.
Absolutely. So I want you to think for a second about your day job, right? Like, imagine you walked into your office, sat at your desk, and just stared blankly at the wall for 8 hours.
You'd probably be fired by Friday.
Right. Exactly. You completely ignore your emails. You do no work. I mean, in almost every aspect of human life, there's this really comforting, linear expectation of effort and reward.
Oh, totally. You train harder at the gym. You get visibly stronger.
Yeah.
You study longer for an exam. You score higher. It is a mindset ingrained in us from kindergarten, basically.
Yeah, we are totally conditioned to believe that hustle and constant activity and, sheer perspiration are the primary drivers of success.
Right. But then you step into the world of investing, and suddenly you are playing a game where the rules are entirely upside down.
Completely upside down. We are looking at a financial landscape where the guy staring blankly at the wall almost always beats the guy who's frantically sweating over his keyboard.
It's true. Trying harder, trading more, and constantly monitoring your portfolio usually results in making significantly less money.
Which is just wild to think about. So today, our mission for this deep dive is to explore this really profound, honestly kind of comical financial paradox. We're going to look at why adopting the mindset of an essentialist investor isn't just like a Zen lifestyle choice to lower your blood pressure.
Right. It's not just about feeling good.
Exactly. It's actually a highly sophisticated, mathematically superior financial discipline.
Yeah, and the core of this philosophy is recognizing a really hard truth. Your biggest obstacle to building long-term wealth isn't market volatility or, inflation.
Or missing out on the next big tech IPO, right?
Exactly. Your biggest obstacle is staring back at you in the mirror. It's your own behavior. Becoming an essentialist investor is about building what we call a behavioral moat around your money.
A behavioral moat. I really love that term.
Yeah, you are intentionally designing a system to protect your capital from your own brain, basically, and from those deeply rooted evolutionary instincts to constantly tinker and react to things.
So I really want to dig into this idea of the behavioral moat. But I feel like to understand why we need it, we should probably look at the people who don't have one, right?
Oh, absolutely. The people trying the hardest.
Right. Let's look at the folks who dedicate their entire lives to doing the absolute most. I'm talking about active Wall Street fund managers.
Yes. The professionals in Manhattan.
Exactly. The guys with supercomputers, armies of analysts, direct lines to Fortune 500 CEOs. I mean, they are trying as hard as humanly possible to beat the market. So does all that relentless hustle actually pay off for their clients?
The short answer is resounding no. And, we don't have to guess here.
Yeah.
We have decades of empirical data tracking this.
Really? Decades of it.
Yeah, it's called the SPIVA scorecard. It tracks the performance of active managers against broad, passive market indexes. And this data acts like an uncompromising referee.
Okay, so it just directly compares them.
Exactly. It compares how actively managed funds actually perform against their benchmarks.
Yeah.
And it carefully accounts for tricks like survivorship bias.
Oh, wait, what is survivorship bias?
So that's when a fund performs so terribly that the firm quietly shuts it down and just erases it from their marketing brochures.
Oh, wow. So they just hide the failures.
Pretty much. So when you strip away the marketing and look at the unfiltered reality, the numbers are just staggering.
Okay, lay it on me. What are the actual numbers?
Over a 20-year horizon, approximately 94% of active large-cap fund managers underperform their benchmark index.
Wait. I need to make sure I'm doing the math right on that. 94%.
94%. Let that sink in.
So if I just blindfold myself, throw a dart at a list of active fund managers, and give them my life savings, my odds of them actually beating a simple passive index fund over 20 years are roughly 6 in 100.
That is the statistical reality.
Yeah. That is insane. The brightest minds in finance working 80-hour weeks fail 94% of the time over 2 decades.
Right. And it's not merely a long-term phenomenon either. Even over a 5 or 10-year time frame, the vast majority of these highly compensated professionals simply cannot beat the market average.
Okay, so I can already hear people listening to this and looking for the loophole. Because I'm an optimist, right?
Of course.
If 94% fail, the obvious solution is to just find the 6% who are winning and give them my money. I mean, if a manager crushed the market by 15% last year, surely they have the talent to do it again.
It seems perfectly logical, right?
Yeah.
But the data points somewhere else entirely. This brings us to a massive trap called the myth of persistence. or, the danger of chasing winners.
Chasing winners, okay.
Yeah. In almost any other profession, a great performance indicates a high level of repeatable skill. Like, if a surgeon has a flawless record this year, she'll likely have a flawless record next year.
Obviously.
Yeah. But in active investing, outperforming the market in one period is rarely an indicator of future success. Performance almost inevitably reverts to the mean.
Reverts to the mean, which is a fancy way of saying their luck runs out.
Exactly. Luck balances out over time.
So last year's genius is this year's fool. Do we actually have hard numbers on that turnover?
We do. If you look at the domestic equity funds that hit the top half of performance in a given year, only about 4.2% managed to stay in that top half for 4 consecutive years.
4.2%.
Yeah, it's incredibly rare.
I mean, if their outperformance was truly driven by unique skill or some proprietary algorithm, you would expect a much higher rate of persistence.
Exactly. Instead, the manager who has a fantastic year is just as likely to have a mediocre or a devastatingly poor one the next.
Wow. So the penalty for picking a manager who suddenly loses their streak vastly outweighs the reward of trying to perfectly time your entry into a winning fund.
Right. Wall Street is effectively flipping coins in very expensive suits.
That is wild. But, okay, let's step away from the institutional guys and talk about the everyday retail investor for a second. Because right now, we are living in the absolute golden age of gamified finance.
Oh, absolutely. The apps are everywhere.
Right. Anyone can download a brightly colored app, get a burst of digital confetti on their screen, and trade options from their couch while watching TV. How is this hyper-accessibility impacting our returns?
It is actively destroying them. It creates a phenomenon researchers call attention-induced trading.
Attention-induced trading. Okay, break that down.
We'll look at how these modern ultra-connected apps are designed. Their primary goal is user engagement, not user wealth. They want you interacting with the interface constantly.
So they're treating it like a social media feed.
Exactly. So they constantly highlight top movers, breaking news alerts, or extreme daily price fluctuations. And this psychological nudging leads retail investors to impulsively buy highly volatile, headline-grabbing stocks.
Man, it's like having an app on your phone that sends a push notification every time a local business catches on fire, and your immediate, unthinking reaction is to rush over and buy their inventory.
That's a really great way to visualize it.
It just feels like pure reaction rather than any actual strategy.
Right. And the behavioral data on these app users is incredibly specific. When a stock experiences an extreme negative price movement, like a sudden, violent drop, users on these gamified apps react amazingly fast.
How fast are we talking?
They typically open new positions within an hour of the drop.
Wow, within an hour?
Yeah, they show a massive preference for jumping into big losers, hoping for a quick, dramatic bounce back.
And I'm guessing that bounce back doesn't actually happen?
Rarely. This rapid, highly reactive strategy consistently results in brutal underperformance. In fact, intense buying of these headline-grabbing stocks by retail users actually forecasts a negative 4.7% average return over the next 20 days for those specific stocks.
A 4.7% loss in less than 3 weeks, that is brutal.
It really is.
And that 4.7% drop is just the surface level math, isn't it? Because all this frantic trading is essentially a leaky bucket. I want to talk about those leaks.
The hidden frictions.
Yes, the hidden frictions of activity. When we factor in the costs, the taxes, and the time, the argument for just sitting on your hands becomes undeniable.
You hit the nail on the head. Every single time you execute a trade, you introduce friction. And over decades, that friction quietly, relentlessly erodes the power of compounding.
So how do we break these frictions down?
We can split them into explicit costs and implicit costs. Explicit costs are the obvious ones we all know about: trading commissions and account fees.
Now, hold on a second. I can open up a brokerage app right now, and it will proudly tell me they offer 0 commission trades. Isn't trading basically free now?
Nothing in finance is free.
Right, I figured there was a catch.
Yeah, if you aren't paying a commission, the brokerage is making their money through implicit costs, most notably the bid-ask spread.
The bid-ask spread. Okay, what is that?
This is the tiny, invisible difference between the highest price a buyer is willing to pay for a stock and the lowest price a seller is willing to accept.
So they are shaving pennies off every single transaction. Does that really add up to anything meaningful?
Massively. Let's say you are an active day trader. In the old days, you might spend roughly $3,000 a year just paying $5 commissions across 50 monthly trades.
Okay, pretty steep.
Right. Today, with 0 commissions, the spread still gets you. A simple 10-cent bid-ask spread on a $40 share quietly eats 0.25% of your return the literal moment you click buy.
Wow, 0.25% just instantly vaporized.
Exactly. If you were churning your portfolio week after week, those fractions of a percent compound into staggering losses over a lifetime. Meanwhile, our essentialist investor, who might execute 3 or 4 index fund purchases a year, is losing practically zero ground to the spread.
Okay, so the frequent trader is getting bled dry by invisible fees. But what about the tax man? Because I know that if you buy a stock and sell it a week later for a profit, you get hit with short-term capital gains,
Oh,
right?
absolutely. And those are taxed at your ordinary income rate.
Which is a huge penalty compared to holding an asset for years and getting the long-term rate. But I want to ask a clarifying question about the funds themselves. A lot of people hold mutual funds, and a lot of people hold ETFs, exchange-traded funds. Don't they both just hold a big basket of stocks? Are they taxed the same way?
On the surface, they look like identical twins. But under the hood, from a tax efficiency standpoint, they are completely different machines.
Really?
Yeah. The true magic of the ETF lies in its structural tax advantage. It utilizes a highly specific mechanism called creation and redemption in kind.
All right, I'm going to need you to pretend I have absolutely no background in finance for a second. Break down that in-kind mechanism for me. Like, if I own a mutual fund, and my neighbor owns the same mutual fund, and he suddenly panics and sells all his shares, do I get punished for his panic?
With a traditional mutual fund, unfortunately, yes.
Wait, really? How does that work?
Think of a mutual fund like a local pizzeria.
Yeah.
If a bunch of partners suddenly want to cash out their stake in the business, the manager has to literally sell off pizza ovens and tables to raise the cash to pay them.
Okay, I'm following.
When a mutual fund manager is forced to sell underlying stocks to pay out panicked investors, they trigger a capital gains tax event. And the IRS passes that tax bill onto everyone still sitting in the pizzeria, even if you never sold a single slice.
Wow. So I get a tax bill in the mail just because other people in my fund couldn't handle market volatility?
Exactly. It's incredibly frustrating.
Yeah.
But ETFs operate differently. Let's use the pizzeria analogy again.
Okay.
An ETF doesn't sell the ovens to raise cash. Instead, they use massive institutional traders. When someone wants out of an ETF, these traders literally swap a massive, fully baked pizza the ETF shares in exchange for a box of the raw ingredients, the underlying stocks.
Oh, so they just trade the assets directly.
Right. This is an in-kind trade. Because no actual cash hits the register at the fund level, there is no sales tax triggered for the IRS.
I see. No cash means no tax event.
Precisely. No forced selling of stocks means no surprise capital gains events for the long-term shareholders sitting quietly in the fund.
That makes perfect sense. Do we have data on how big of a difference that structural advantage actually makes in the real world?
The contrast is honestly night and day. Looking at industry data from 2025, a massive 57% of equity mutual funds paid out a capital gain to their investors.
57%?
Yeah. Compare that to just 6% of equity ETFs.
57% versus 6%. That is wild. So the mutual fund investor is getting a surprise wealth-destroying tax bill almost every other year, while the ETF investor just gets to sit back and let their money grow uninterrupted.
Exactly. That is a massive structural advantage. But, we haven't even touched on the most valuable hidden friction of all.
What's that?
The opportunity cost of your time. Actively managing a portfolio, researching stocks, reading earnings reports, and watching the ticker, it is not a casual hobby. It is a demanding, high-stress, part-time job.
Oh, absolutely. The people who take day trading seriously are chained to their multiple monitors. We're talking upwards of 40 hours a week of screen time.
It's exhausting.
Compare that to the minimalist investor who might spend, 1 or 2 hours a quarter just checking in and making sure things are balanced.
Right. Let's attach a dollar value to that screen time to really make it concrete.
Yeah.
Let's say you value your personal time at a modest $50 an hour.
Okay, $50 an hour.
If you spend just 10 hours a week researching and actively trading, you are incurring an invisible annual fee of $26,000.
26 grand.
Yes. For your active trading to actually be worth it, you don't just need to beat the market. You need to generate an extra $26,000 in pure profit above what a simple passive index fund would have made you.
And as we established with the 94% failure rate of Wall Street pros, the odds of you doing that are practically zero.
Exactly. You are paying a massive premium in time just for the illusion of control.
The illusion of control. I think that phrasing is the perfect bridge into the psychology of all this. Because let's be honest, if the math is a bloodbath, if the taxes are punishing, and if it costs me a part-time job's worth of hours, Why is my buddy still frantically buying and selling on his phone while waiting at a red light?
Right? Why do it?
Yeah, why is the urge to tinker so irresistible?
Because we are fighting hundreds of thousands of years of human evolution. The financial markets are a modern invention, but the brains we're using to navigate them are ancient.
I feel like a lot of this comes down to how we perceive danger.
It totally does.
It reminds me of furiously mashing the button at a crosswalk. Deep down, you know that pressing it 10 times isn't going to make the traffic light change any faster.
But you do it anyway.
Right. But standing there, doing absolutely nothing while cars whiz by, it just feels agonizing. Taking action, even useless action, makes us feel safer.
That is a brilliant way to describe action bias. It is our automatic, deep-seated tendency to take action, especially in times of stress, even when the most rational choice is to hold off and do nothing.
So how does that play out in the market?
Well, when the financial markets experience volatility, when you see red numbers and your portfolio dips in value, your brain doesn't see a temporary economic fluctuation, it sees a physical threat.
So it's like a predator in the bushes.
Exactly. That exact same fight-or-flight instinct kicks in, and your ancient brain screams at you to do something to survive.
And in the stock market, doing something usually means hitting the panic button and selling at the absolute bottom of the cycle.
Precisely. We sell the asset, not because it's a sound financial strategy, but simply to relieve the psychological discomfort of uncertainty. We trade just to feel like our hands are on the steering wheel.
But the tragedy is that by doing so, we turn temporary, meaningless paper losses into permanent, irreversible financial damage.
Exactly. You lock in the loss.
So our survival instincts are actively bankrupting us. But action bias can't be the only psychological trap. I feel like a lot of active trading is driven by pure ego.
Oh, definitely.
Like people just genuinely believe they are the smartest person in the room.
You are absolutely right. Overconfidence is a lethal trait in investing. Individual investors chronically overestimate their ability to predict market movements.
They think they know better than everyone else.
Right. They believe they have some special insight, a gut feeling, or the ability to spot patterns that the collective wisdom of millions of global market participants somehow missed. And the research shows this is particularly, and perhaps unsurprisingly, prevalent among males.
I am shocked. Truly shocked. Males being overconfident.
I know, hard to believe.
But seriously, how much does that ego actually cost them?
The research specifically linking gender overconfidence in stock investment finds that this unwarranted confidence leads directly to excessive trading. And that excessive trading reduces net returns by up to 2.65 percentage points every single year.
2.65% a year. That is an incredibly steep price for an ego trip.
It really is.
If you compound a 2.65% drag over 30 years, you are talking about losing out on hundreds of thousands of dollars.
Easily. And the psychological traps compound, too. Let's look at how active traders handle the stocks they actually own. They frequently fall victim to a phenomenon called the disposition effect.
The disposition effect, what is that?
Well, have you ever noticed how hard it is to admit you made a bad purchase?
Oh, definitely. If I buy a gadget that turns out to be useless, it will sit in a drawer for 3 years before I finally throw it away. Admitting it was a waste of money is painful.
Exactly. Now apply that to the market. It creates what behavioral economists call a doom loop.
A doom loop. Okay, that sounds bad.
It is. Active traders have a terrible habit of selling their winning investments way too early. When a stock goes up a little bit, they cash out because it gives them a quick hit of dopamine.
It validates their intelligence.
Right. And it locks in a tangible profit.
Mm.
But conversely, they hold on to their losing investments way too long. They refuse to sell a loser because selling it makes the loss real.
It means taking an ego hit and admitting they were wrong.
Exactly. So they hold on to the sinking ship, desperately hoping it just bounces back to the price they paid for it so they can break even.
You're pulling out the flowers to make room for the weeds?
That's a great way to put it.
But here's my question. If I touch a hot stove, I learn very quickly not to touch it again. Does losing money in the market eventually teach these active traders to change their behavior?
You would hope so, but the data reveals something truly tragic. Experiencing past significant losses does not make an investor wiser. It actually amplifies the disposition effect bias by 10%.
Wait, losing money makes them 10% more likely to repeat the exact same mistake?
Yes. The psychological scar tissue doesn't make them more disciplined, it makes them stiffer and more fearful.
Wow.
After a big loss, an investor becomes even more desperate for a quick, validating win. So the next time they have a stock that goes up slightly, they sell it even faster.
Because they're terrified.
Exactly. And because they are terrified of realizing another big loss, They cling to their next sinking stock even harder. They churn their portfolio in the exact pattern that produced the losses in the first place. That is the doom loop.
Okay, you have thoroughly terrified me.
Okay.
Between the 94% failure rate of the pros, the invisible fees, the punishing taxes, the action bias, and the doom loop.
Active trading sounds like a nightmare.
It really is a game stacked against you.
So how do we actually escape this? How does the listener practically build this behavioral moat? What does the essentialist investor actually do?
The beauty of the solution is its extreme simplicity. The gold standard of financial minimalism is building what is commonly known as the three-fund portfolio.
The three-fund portfolio. Instead of frantically trying to pick individual winning stocks or time the market sectors, you hold just 3 broad market index funds. Typically, this consists of a total domestic stock fund, a total international stock fund, and a total bond market fund.
That's it. I don't need a slice of a trendy AI startup or a biotech firm or a new EV company, just 3 massive funds.
That's all you need. With those 3 funds, you literally own a fractional piece of almost every significant publicly traded company on the planet, balanced with a stabilizing layer of bonds.
That is incredibly simple.
You aren't exhausting yourself trying to find the needle in the haystack. You are just buying the entire haystack.
I love that. It perfectly captures a famous piece of advice from the legendary investor John Bogle, who pioneered the whole concept of index investing. He used to tell nervous investors, don't do something, just stand there.
It is profound advice because it flips our natural instincts upside down. The most profitable skill an investor can cultivate is intentional inaction. Inactivity by design.
Right, fighting that crosswalk button urge.
Exactly. And the best way to achieve this is by removing your own willpower from the equation entirely. You automate your investments.
So you don't even have to think about it.
Right. You set up a system where a specific portion of your paycheck automatically buys into your 3-fund portfolio every single month. It happens quietly in the background, regardless of what the market is doing, regardless of who is president, and regardless of what the breaking news headlines are screaming.
You turn wealth building into a boring, entirely mechanical habit. You completely remove the emotion, the ego, and the temptation to press the button.
Precisely. You stop trying to predict the unpredictable. Instead, you humbly rely on the long-term, historical upward trajectory of the global economy. You let the math of compounding do the heavy lifting while you go live your actual life.
Now, I do want to throw in a quick, relatable caveat here because I think it's an important distinction for our listeners. We are singing the praises of minimalism, but you shouldn't take financial minimalism so far that it actually damages your earning potential in the real world.
Oh, that's interesting. What do you mean by that?
Well, don't be so obsessed with saving pennies that you skip a highly valuable industry networking event just to save $50 on a ticket. Or don't refuse to buy a fast, reliable laptop that you desperately need for your freelance business because you want to put that $1,000 into your index fund.
Right. You can't starve your own growth.
Exactly. The rule of thumb should be ruthlessly minimalist and boring with your investment portfolio, but be expansive, aggressive, and abundant with your career and your personal growth. Your career is your primary wealth-generating engine. Your portfolio is just the highly efficient storage facility for that wealth.
That is a phenomenal distinction. The goal isn't to be cheap. The goal is to be radically efficient where it matters most. Think about what you are actually getting when you embrace the essentialist investor mindset.
You're getting your life back, for one.
Right. You are granting yourself 3 distinct life-changing advantages over the vast majority of market participants. First, you have the math on your side. By capturing the total market return while paying practically 0 fees, you mathematically guarantee that you will outperform the vast majority of active traders and highly paid Wall Street professionals over a long-term horizon.
So you get to beat the guys in the expensive suits without even trying.
Exactly. Second, you secure a massive structural advantage. By utilizing incredibly tax-efficient vehicles like broad market ETFs, and by refusing to trigger short-term capital gains, you minimize the brutal friction of taxes and trading spreads. You keep more of your own money compounding year after year.
And then there's the third advantage, which honestly might be the most valuable of all, the psychology.
Right. You eliminate the ambient anxiety of constant portfolio monitoring. You bypass the evolutionary traps of action bias, overconfidence, and the doom loop. You reclaim your mental peace.
And you reclaim your time. Which brings me to the final provocative thought I want to leave with you, the listener, as you mull over everything we've unpacked today. We talked earlier about the invisible fee of time, the hours spent stressing over trades, reading financial news, and watching tickers.
It's a huge drain.
It is. If you suddenly gain back 30 or 40 hours a month by abandoning the anxiety of active trading and embracing a boring, automated, set-it-and-forget-it philosophy, what are you going to do with that time?
That is the real question.
What new skill, what hobby, what relationship, or what career advancement could you invest those hours into? Because investing your time into yourself is the one asset class that offers a 100% guaranteed return.
Absolutely. Time is the ultimate asset.
This was it on today's topic, guys. Kindly subscribe and follow us for more such insights on various discussions on money, and also do not forget to join our social media community to stay in touch and get updated.